Property is a very popular asset class amongst SMSFs, but the focus tends to be more on residential property. Joining me today is Head of Charterhall Direct, Nick Kelly, to discuss why commercial property perhaps warrants a little bit more consideration. Welcome, Nick.
Thanks for having me on the show, Darren.
It's my pleasure. Now, when SMSFs invest in residential property, sometimes it's on the premise that residential property prices will never go down. Look, is that a valid assumption?
Well, it's certainly been a valid assumption for the last 20 years. If you look at residential property in Australia, it has had a stellar run. Globally, Australian residential property has been one of the strongest performing residential asset classes in the world. And I would just caution investors that sometimes you have to be careful. If you've gone through we're now sitting on a 24-year run of positive national residential price movements, it doesn't always go positive forever. A good example is 91, 92. Australia had a very severe recession. Property houses across the board fell in value, and some cities in particular fell materially. What is interesting right now, and this is for the first time in a long time, we are seeing some capital city markets move into negative territory. Perth's one example where prices have fallen 5% in the last year.
So in that context, is there a more accurate way SMSF investors should look at residential property as far as property values go now?
Well, look, I wouldn't say, and Charterhall Group would never say sell all your residential holdings. All we're saying is historically, absolutely, it's been a fantastic performing asset class. A great competitive advantage of owning a residential property as an investment is you have full control. You can buy it when you wish, you can sell it when you wish. If you're very good at what you're doing, you can try and pick markets that are going to perform well in the future as well. And we're definitely not saying residential prices are going to crash, because you only have to look at the population growth in the major metropolitan areas of Australia, and we have very strong population growth in Sydney, Melbourne, Brisbane particularly. So there are certain suburbs where houses are going to perform very well. One part of the market that we would caution investors to just be wary of if they're looking at allocating new money today is the apartment sector. If you look at the long-term history of apartment construction in Australia, on average from 1960 to 2005, this country developed anywhere between 15,000 to 30,000 apartments per year. In the last few years, this country has developed somewhere between 75,000 to 125,000 apartments per year. And this year alone, there's 175,000 apartments being built right now. And looking at the development approvals for next year, potentially 225,000 in 1 year. So effectively, this year and next year combined is the equivalent of what we have built 15 years for the 15 years previously. There's good reasons for that. There's demand, there's investment demand, there's strong population growth as well for owner-occupiers who want to live in apartments, strong demand for apartments for affordability reasons, because apartments are much cheaper than homes in certain suburbs. But if you just look at the raw numbers and look at some of the charts in terms of the construction taking off like a rocket ship, there are going to be some particular suburbs in all cities where there will be an oversupply of apartments, where potentially you'll see higher vacancies. Higher vacancies lead to lower rents. Lower rents longer term mean you might have an environment where if prices don't fall, what you're paying for an apartment today in some of those markets, you might be selling it for the same price 10 years from now. So you've just got to be wary, particularly in that high density part of the market.
Mm-hmm. If we turn our attention to commercial property, the SMSFs do have some allocations towards them right now. What are the typical allocations to commercial right now?
Well, what's interesting is if you look at the latest statistics on self-managed super funds, they do, if you just look at the raw numbers, have quite a lot of commercial real estate. On average, the allocation is about 13%. Mm-hmm. But if you look into that 13% allocation, that is mainly private business owners who have actually put their business premises into their self-managed super fund. If you ignore those individuals who have self-managed super funds who own their own business, who've put their property into the fund, the average allocation is less than 3%. So the typical Australian self-managed super fund has a very low allocation to commercial real estate. We certainly think it's too low, principally because if you look at the way institutions, large institutions and pension funds manage their money, they're investing anywhere between 10 to 15% of their whole portfolio in commercial real estate. So self-managed super funds are definitely very underweight the sector, and we don't think they've done that on purpose. We think that's a bit of education for the industry, that self-managed super funds actually don't know how they can get into the sector.
Yep. So outside of their own business real property, what are some of the other commercial areas that they should look at, and what sort of returns or returns can be expected from those areas?
Sure. So property is an income asset class. So if you were to invest today in commercial real estate, you've really got two avenues that you can invest your capital into. You can move into the listed REIT sector, which is commercial property trusts that are listed on the stock exchange, or you can invest in unlisted property funds. We're across both asset classes because we're one of the largest managers in Australia of unlisted property funds, but we also manage two listed REITs on the stock exchange, and Charter Hall Group is one of those REITs. If you look at the market pricing of where listed REITs have got to today, if you invested today, the dividend yield's 4.4%. So in terms of an income return from the REIT sector, you'd be getting about 4.4%. That might sound low, but then that is quite high compared to term deposits that are sitting at 2.6%, and government bonds are sitting down at 1.9% at the moment. So you are getting higher income than bonds or cash. The advantage of unlisted property funds at the moment is their pricing is based on the underlying fundamental value of the buildings, and they're not priced on sentiment, so they haven't, I suppose, boomed like the listed REIT market has boomed in terms of the share prices. So when you're investing in unlisted property funds that we manage and our peers in the industry manage at the moment, you can get income anywhere from 6.5% right up to 8% per annum. So that's a healthy margin of income for those SMSFs that are looking to boost income in their portfolios.
Yep. Having said all that, is there any valid reason for investors to make a choice between listed and unlisted?
There certainly is. The advantages of investing in the listed REIT sector is if you find that sometimes you make an investment decision and you want to change your mind, if you're one of those investors that might make a decision and the next month change your mind, you can effectively buy your position on Monday and you can sell it on Tuesday. So you've got a lot of liquidity. It's basically just like buying or selling a share. So that's a great thing about investing in listed REITs. The disadvantage of listed REITs, because they're listed on the stock exchange, is they are impacted sometimes by market sentiment, domestic events, or even global events that actually fundamentally have nothing to do with the value of a building like the building we're sitting in today. So the prices of the listed REITs move up and down. They can, in stock market crashes, they can move down. In global financial crises, they can move down. Even terrorist events globally, for some reason, listed REITs can move down. So that's the disadvantage of the listed market. If you're sick of volatility and you're sick of making investments and moving and the price of the investment moving around a lot, unlisted property funds might be the way to go. They're investing in exactly the same types of assets: office buildings, industrial warehouses, shopping centres, or we do a lot of Bunnings warehouses as well, leased to great tenants on very long leases. But we don't list the funds on the stock exchange. They're unlisted vehicles, and the value of the unit price is linked to what the independent valuer every year says the building is worth. And what's interesting, if you analyse unlisted versus listed markets over the last 30 years, unlisted property in Australia has actually been the best performing asset class, both return-wise but also particularly risk-wise. The volatility of unlisted property funds is very, very low and provides higher income.
So why would now be the right time for an SMSF investor to start looking at maybe a better allocation or a larger allocation to the commercial property sector?
We think a key reason to look at commercial real estate now, if you don't have an allocation, and from what I gather there's lots of self-managed super funds out there that actually have a 0% allocation to the sector, is again coming back to income. If they're looking for income, you can certainly get it in the Australian stock market, where that's trading at the moment. It's giving you a dividend yield of about 4.2%, and with franking credits you might be getting in the mid-sixes pre-tax. So the stock exchange and stocks will certainly give you good income. But anything can happen in the world. The world's a very volatile place. Anything, you might be chasing that 4.2% income in dividends in the stock market, but it might be worth 30% less 3 months from now. So we think for investors that already have a lot of their money sitting in term deposits, earning low income, a lot of their money sitting in Australian shares, and the average SMSF has about 30 to 40% of their portfolio sitting in the Australian stock market, by the way, which a third of that is Australian banks that are heavily exposed to the residential cycle. We just think it makes sense that if you wish to boost income and look at another asset class for diversification reasons, that actually also gives you protection if the stock market falls, unlisted property funds are a good place to be, particularly with the high income at the moment.
Okay, fantastic. Well, thank you very much for your time today, Nick.
Thank you, Darren.